In the space of 48 hours, the gold market did something it's not supposed to do. It ripped to an all-time high near $5,626 an ounce, then snapped lower into the 4,700s, as if someone pulled the floor out from under the entire complex. And silver didn't just fall, it fell roughly 31% in a single day, a percentage collapse people still associate with March of 1980, not a modern, electronically cleared market. That kind of move breaks expectations because gold is sold as the steady asset. It's the thing that moves when everything else is moving. It's the insurance policy. And yet the insurance policy itself just got repriced like a high beta tech stock. Not months, not weeks. In 48 hours. Here's the part most people miss. When a market moves that violently, it isn't only price discovery. It's also forced discovery. Somebody had to sell. Somebody had to meet margin. Somebody had to reduce risk because a model, a committee, a clearing rule, or a funding line told them they had to. That's why these events are so revealing. They show you the plumbing. And while the headlines argued about why gold fell, institutions were already looking at something else, real yields. Because real yields are the gravitational field for long-duration assets. And gold is a long-duration asset in disguise. It's not a coupon. It's a claim on purchasing power. For years, the story was simple. When real yields fall, gold rises. When real yields rise, gold struggles. But now real yields just flipped gold's setup, and gold is telling you very quietly that the old map might not match the territory anymore. Welcome to Roki Macro, where we decode what matters before it becomes the headline everyone repeats. If you like analysis that starts with the numbers and ends with the mechanism, you're in the right place. And if you're listening like that wise elder who doesn't talk much but always notices what's changing, you already know what to do. Also, drop a quick comment with where you're watching from, because I read them and it helps me understand what the market feels like in different corners of the world. Now let's reconstruct what actually happened. The sequence matters. Late January into the first days of February, the market was hit with a shock that wasn't a single data print. It was a narrative shock about policy. In plain terms, traders suddenly interpreted the path of rates as less forgiving, more restrictive, and potentially more durable than they had priced just days earlier. The reaction wasn't limited to metals. It rippled through duration, through equities, through funding, through volatility. Then the metals complex did the thing it often does right before it does the thing it's famous for. It overshot. Gold ran hard into a fresh high around 5,626, a move that pulled in late momentum, short covering, and the kind of reflexive buying you get when everyone's chart tells them the same story. Silver, which tends to amplify gold's emotion, surged as well. And then almost immediately, the price action turned from trend to liquidation. Gold fell into the 4,700s. Silver suffered a one-day drop around 31%. It signals a positioning event, a funding event, and a risk event all at once. It signals that the market wasn't just changing its mind, it was being forced to. Here's the central mystery, 9%. Think about what that means. A risk-free instrument adjusted for inflation was offering a real return that many investors haven't seen for long stretches of the post-2008 era. In the old framework, that's poison for gold. The high and rising real yields increase the opportunity cost of holding a non-yielding asset. So why did gold run to a record high into that environment? And why, after the crash, did parts of the market still behave like the bigger move might not be over? To answer that, you need the pattern, not the opinion. The pattern. In 1980, precious metals were the purest expression of inflation panic and policy credibility. Silver and gold moved like a public referendum on whether money would hold its value. The subsequent collapse wasn't a gentle return to normal. It was a violent reversal, fueled by leverage and rule changes that punished late buyers and reset the game. The result was a new regime where policy restored credibility for a time and the trade moved from mania to patience. In 2008, gold did something that still surprises people who only remember the end of the movie. During the worst liquidity crunch in generations, gold sold off with everything else. Why? Because in a true funding crisis, you don't sell what you want to sell. You sell what you can sell. You sell what has liquidity, you sell what meets margin fastest. The result was that initial dip, followed by a powerful recovery when central banks responded with balance sheets and rates that crushed real yields. In 2011, gold peaked into another regime shift. It wasn't just about inflation then, it was about trust, about sovereign balance sheets, about the European debt crisis, about the limits of policy. And the turn wasn't triggered by one chart. It was triggered by the market beginning to price a different policy path. Real yields rose, the dollar strengthened, and gold corrected hard. A reset. Now look at early 2026, a record high, a sudden collapse, a sharp repricing of real yields, and, simultaneously, evidence that sophisticated traders were still reaching for upside exposure, with strikes and structures pointing to levels like $10,000, $15,000, even $20,000 an ounce in the options market. That doesn't mean those levels are destined. It means someone was paying for convexity in the middle of fear. That's rarely random. So who are the players when this happens? Start with the obvious. Futures exchanges and clearinghouses. When volatility spikes, margin models react. They demand more collateral. That is not a moral judgment. It's risk management. But it has a predictable effect. Higher margin requirements force leveraged participants to shrink positions. Shrinking positions means selling. Selling into thin liquidity means bigger moves. Bigger moves mean higher volatility. Higher volatility means higher margin. That feedback loop is how a market turns from orderly to brutal. Then you have systematic strategies, CTAs, trend followers, volatility control funds, risk parity allocations. These strategies don't believe in gold. They respond to signals. Price breaks, volatility spikes, correlations shift. When the models flip, they execute. And they often execute together because they are reading the same data at the same time. Then you have banks and dealers managing hedges. When clients rush to buy protection or upside, dealers hedge by buying or selling the underlying, which can amplify moves. If clients buy put options on metals, dealers may sell futures to hedge. If clients buy calls, dealers may buy. The hedging flow can create a second-order wave that looks like mysterious pressure to outsiders, but is simply mechanics. Then you have the largest invisible player, collateral. The modern financial system runs on collateral chains. Treasuries are collateral. Cash is collateral. The ability to fund positions overnight is collateral. When rates expectations change abruptly, the entire collateral ecosystem reprices. Haircuts widen. Funding costs rise. Risk managers tighten. That tightening can force liquidations in assets that are not directly related to the shock. This is why a policy narrative shock can crash silver like it's 1980. It's not that everyone suddenly decided silver is worthless. It's that silver is often the leveraged expression of a broader liquidity event. Now we get to the dislocation, the thing that doesn't match. 9% on the 10-year, 3%. Put those together, and you get a market that is not pricing runaway inflation. It's pricing inflation that's present, but bounded. In that world, gold should be a calmer asset, not a rocket ship. On the other side, you have gold printing a record high anyway. And after the crash, you have evidence of traders still paying for extreme upside tails. Those two facts do not comfortably coexist in the old story. That's the clue. Gold is pricing a world where policy can be restrictive and still not fully restore confidence, because something else is tightening at the same time. Liquidity, sovereign issuance, geopolitical risk, supply chains, the credibility of forward guidance, the market's belief in smooth landings. When real yields are rising and gold is rising, it's usually telling you that the market is not treating those real yields as stable. It's treating them as fragile. It's treating them as a temporary offer that might not be honored in the way people assume, because the system that produces those yields could be forced to change course. There's also a geographic layer that appears whenever the paper market gets violent. When futures become the instrument of forced selling, the price can fall faster than the physical market can respond. A dealer doesn't reprice a bar on a shelf every second. A refiner can't instantly increase output. And large buyers in Asia and the Middle East often treat sharp downdrafts as inventory windows, not as a verdict on the metal. That's how you get the strange split where paper looks like it's in free fall while physical premiums quietly stay firm because real buyers don't vanish at the same speed as leveraged sellers. It's the same reason West versus East narratives show up. Western demand is frequently financial and mark-to-market, expressed through futures, options, and ETF flows, while Eastern demand is often savings and cultural, expressed through jewelry, bars, and wholesale imports. Those are different clocks. If you want a close parallel, look at 2013. Gold didn't drift lower. It was hit by a waterfall sell-off as expectations around policy shifted and large positions were unwound. It was the market repricing the policy path, which changed funding and leverage conditions. In the aftermath, physical buying intensified in regions that treat gold as long-term savings. Now connect that to early 2026, 9%, then an air pocket that looked like a liquidity event. Reset events are when the market reassigns who is forced and who is free. Leveraged players become sellers because they have to. Strong hands become buyers because they can. And the narrative reorganizes around the variable that is now controlling the system. This also clarifies why official sector demand still matters even when it slows. A year like 2025 can see central banks buy on the order of 863 tons, with a single buyer, like Poland, adding roughly 102 tons, and that demand is not chasing a candle. It's a reserve preference. It reflects a desire to hold an asset outside another institution's liability structure. At the same time, private institutions express their view differently. They don't announce shifts, they structure them. In a world where real yields are high, that is fear of discontinuity, not drift. And that's the hidden contradiction. Restrictive policy can coexist with rising systemic risk. Tight financial conditions squeeze weaker balance sheets, widen spreads, and raise funding stress. Funding stress increases the value of hedges that don't depend on someone else's promise to pay. That hedging bid can keep gold supported even when the yield math argues it shouldn't for longer than models expect. Now let's talk evidence with numbers, because stories are cheap and data is expensive. First, the move itself. Gold near 5,626 to the 4,700s is not a routine correction. That's a drawdown that compresses months of risk into days. Silver down roughly 31% in a day is the definition of stress. Those are the fingerprints of leverage being unwound, not just sentiment turning. Second, the real yield level. 9% is high relative to much of the post-crisis period. It's a level that, in theory, competes directly with gold. If gold rises anyway, it implies the market is willing to pay an opportunity cost to hold an asset outside the credit system. Third, central bank behavior. Reported central bank gold purchases in 2025 were around 863 tons, with specific buyers like Poland adding roughly 102 tons. That's less than some prior years, yet it's still large in the context of official sector demand. And the key is not just the total, it's the persistence. Official demand doesn't chase daily candles, it reflects long horizon reserve management. Fourth, options behavior. In the middle of the worst day in decades, traders were still structuring exposure that benefits from outsized upside moves, referencing strikes up to 20,000. Again, that's not a forecast. It's a window into what the sophisticated part of the market worries about, even when prices are falling. They worry about a discontinuity. Now, if you're thinking, okay, but what actually caused the crash? The answer is almost never one thing. It's a chain. Here's the mechanism in plain language. Imagine a crowded theater with one narrow exit. Everyone is calm until someone smells smoke. At first, people stand up, then they move, then they run. The exit doesn't change, but the flow does. In markets, the exit is liquidity. When volatility spikes, liquidity shrinks because market makers widen spreads and reduce size. At the same time, margin requirements rise. That means traders need more cash to hold the same position. Where do they get the cash? They sell. If enough people are levered, the selling becomes self-reinforcing. Prices drop. Losses trigger more margin calls. More margin calls trigger more selling. That selling pushes prices lower still. This is why declines can be vertical. And silver is especially vulnerable because it's thinner, more volatile, and often held with more leverage relative to its liquidity. When the crowd rushes the exit, the thinner market gets trampled first. Meanwhile, gold, being larger and more liquid, becomes the source of cash for some participants. They sell gold not because they hate gold, but because it's the cleanest way to raise dollars quickly. That's 2008 logic. It can repeat whenever funding is the real problem. So the crash is the visible part. The repricing of real yields is the invisible part. And the flip in gold setup is what emerges after the dust settles. For years, the macro playbook was built on the idea that real yields would remain structurally suppressed. Aging demographics, debt loads, central bank policy, and crisis management created an environment where nominal yields could rise, but inflation expectations and policy reactions would keep real yields capped. In that world, gold had a supportive backdrop. Not every day, not every month, but structurally. Now the market is testing a different world. A world where real yields can stay high for longer, where the hurdle rate for non-yielding assets is higher, where the cost of leverage is higher, where funding is tighter. And yet, gold still managed to run to a record. That suggests there is demand that is not purely rate sensitive, demand that is about balance sheet risk, currency risk, and the desire for an asset that is no one else's liability. This is where it gets interesting. Because when you see a dislocation between paper price action and underlying demand narratives, you have to ask which one is leading. Paper markets can move faster. Futures can liquidate instantly. Options can rehedge in seconds. But physical demand, official reserve management, and long horizon allocation decisions move slower, and they can be invisible until you zoom out. So what can't persist? A world where real yields are high and stable and gold is also making record highs is internally inconsistent unless something else is breaking the stable assumption. Either the market believes real yields won't stay this high, or the market believes the meaning of those yields is changing, or the market is hedging a scenario where the policy response function will flip back toward suppression under stress. Historically, when this tension appears, it resolves through one of a few pathways. In the conservative scenario, the system absorbs the shock. Volatility fades, margin pressure eases. Real yields remain elevated, gold stabilizes lower, and the market moves into a grinding range where buyers and sellers renegotiate value without panic. In that scenario, the record high becomes a reference point, not an immediate destination. In the moderate scenario, the market experiences repeated liquidity tremors. Each tremor forces another round of de-risking, but each recovery attracts a strategic demand because the underlying reasons for holding gold don't disappear. Real yields oscillate. Gold becomes less correlated to the old drivers and more sensitive to stress indicators like credit spreads, funding rates, and currency volatility. In the aggressive scenario, something forces a policy pivot. It could be financial conditions tightening too far, too fast. It could be a credit event. It could be a growth shock. It could be a sovereign funding concern. In that scenario, real yields fall sharply, not because inflation surges, but because the system demands relief. Historically, that is the environment where gold's non-yielding nature stops being a disadvantage and starts being a feature. Notice the framing, not predictions, conditions. If X continues, historically Y follows. So what should you watch that tells you which path we're on? Watch real yields, but watch them in context. 9% matters, but what matters more is whether it's rising because growth is strong or rising because policy is tightening into fragility. Watch credit spreads, watch dollar funding indicators. Watch volatility in rates markets because that's where stress leaks into everything else. Watch the behavior of silver relative to gold. When silver collapses and then fails to recover, it can signal a risk-off environment where speculative demand is gone. When silver collapses and then snaps back, it can signal that liquidation was mechanical and demand is returning. Watch the shape of the curve. When the front end is anchored by policy and the long end is volatile, it tells you the market is uncertain about the future path. Uncertainty is fuel for hedging behavior, and watch the way the market reacts to seemingly small headlines. In stable regimes, headlines cause noise. In unstable regimes, headlines cause gaps. Gaps are information. Now, let's address the viewer's real question, the one behind the question. What does it mean if institutions moved first and the public notices last? It means the divide is not intelligence, it's attention to mechanism. Retail tends to react to the candle, institutions react to the funding terms that create the candle. By the time the price is screaming, the positioning and the collateral have already shifted. This is why those extreme options, strikes, matter. Not because they're a prophecy, but because they reveal that someone with size is still paying for a scenario where gold's upside is discontinuous. They are buying the kind of exposure that benefits if the market stops moving in increments and starts moving in steps. And that brings us back to the title, Rates Repriced. Real yields flipped gold's setup. That is a different interpretation. It's not bullish or bearish, it's structural. The market just told you that the old single variable explanation is breaking. It's telling you that gold is no longer simply a bet against inflation. It's a barometer for confidence under constraint, in a world where policy can be tight and still not fully reassure the system. And once you see that, you stop looking for one headline to explain every move. You start looking for the stress points, collateral, margin, liquidity, policy reaction functions, and the quiet flows that don't care about today's argument. This is Roki Macro, where we decode what matters before its headlines. If this connected dots you hadn't lined up yet, you know what to do. The question isn't whether markets will stay calm. The question is whether you'll recognize the regime change before the next repricing makes it obvious.